Hi everyone, welcome back. Okay, let's start. Hi, good evening everyone. I'm Darren from Investing Note. Thank you for joining us today. Today is the third day. Okay, so this is the second sessions. So the topic for these sessions will be the fundamental shift, how we can look at our 2021 portfolio. And today we have T-Link as the speaker for these sessions. So T-Link is the portfolio manager of Heritage Global Capital Fund, and he also having over 10 years of experience in the financial market. He is the director at Hua Groups. Additionally, he also a frequent speaker at the investment conference held by SGX, RHB, and also CIMB. Okay, so if you have any questions during the presentation, please type them into the question box, which is the orange box on your right hand side. Okay, you can just enter your question over there. So today we also have a Q&A sections. Okay, without further ado, let's welcome T-Ling. Hello, T-Ling, are you there?
Hi, thank you, Darren, for the introduction.
Hi. So the time is yours.
Sure,
Thank
thank
you.
you. Let me just share the slides.
Yeah, sure. Okay. Yep, I can see your slides.
So, good evening, everyone. Thank you for actually taking the time on a Friday evening to actually attend today's presentation. I hope everyone has actually had their dinner already, or probably you guys might actually be having your dinner right now while watching this webinar. And that's the beauty of technology today. It has actually allowed for things to become so much more efficient. And in some ways, we have to actually thank the COVID-19 pandemic, because it was because of the COVID-19 pandemic that actually spurred for all these technological shifts. But I will touch more about this on the later slides. For today's presentation, it will be something very different compared to what I usually talk about. People in the audience who have actually followed me for quite a while will probably know that I usually am always talking about deep value investing, and more specifically, the capital cycle approach. But for today's presentation, I'll be talking something different. I'll be talking about the fundamental shifts that I'm actually seeing in the economy today, how we can actually be assessing our portfolio, and how we can best position it for 2021 and going forward. So for today's presentation, it will be on the fundamental shift and how we can actually look at our 2021 portfolio. So for the agenda today, I'll start off with an introduction, and then I'll be reviewing what has actually happened in 2020. I'll be sharing some of my thoughts on what I believe the economy would be looking like 2021 onwards. And I've actually buffered more than sufficient time for Q&A, because I believe that's where you guys can actually extract the most value by us actually asking questions. So my name is T-Ling, as what Darren said. I'm the portfolio manager of Heritage Global Capital Fund. It is a long-only value fund based in Singapore. I'm also a blogger at Investing Nook, which is my own personal blog where I share on my thoughts and experiences in the financial markets. Lastly, I graduated from University College of London, majoring in economics. So, what has actually happened in 2020? Other than the obvious fact that we have actually experienced it, and we are actually still experiencing it, the effects of the COVID-19 pandemic, can you guys think, what are some other stuff that have actually resulted from this pandemic? Many of you might actually realize how your lives have actually changed quite significantly pre-COVID as compared to what it is today, be it your daily lives or your work lives. Working from home now seems more like the norm. This is not to say that, offices will be completely abolished, but management will be reassessing, trying to streamline job processes, workflows, and, maybe jobs that do not require you to always be in the office. Management might feel that it's okay for you to actually be working from home. Maybe they'll just give you a hot desk as and when you actually need to come into the office. You don't actually have a specific work desk, but more of a hot desk format. Perhaps even overseas work trips are becoming more and more redundant if meetings can actually be held via Zoom. Even let's say signing of documents is slowly transiting online because of softwares such as DocuSign or Adobe Sign. So on a more personal level, your daily lives, how you go about shopping, buying products, and people are doing their shopping more and more on e-commerce platforms such as Taobao, Shopee, Lazada, etc. And there are so many e-commerce platforms out there today. And this is becoming more and more common, going online shopping on e-commerce platforms, especially for the older generation. And this is something that I've actually personally witnessed in my own family and amongst my relatives. Because of the COVID-19 lockdown, my parents, my relatives were actually forced to actually go online to actually buy products or groceries online. So before COVID, my mom is someone who is a traditional housewife. She would wake up early in the morning to go to the wet market to choose the freshest meat, to choose the freshest vegetables to actually buy home and cook it. But because of the COVID lockdown, she was unable to actually go to these wet markets and was actually forced to actually turn to alternatives like shopping on RedMart. Previously, the reason why she was not willing to actually buy these kind of stuff online was because she always felt, or my parents always felt that products online, be it on Taobao, might be of a inferior quality, or groceries, if you are not actually choosing it at a wet market, it's not very, very fresh. But because of this COVID lockdown, they were actually forced to actually go online and do all their shopping online. A lot of their initial beliefs were actually dispelled. They realized that whatever they thought it to be was actually not true. The quality they were actually buying, the products they were actually buying on Taobao were actually of quite good quality. It was not as bad as they thought it to be. The groceries that they were actually buying on RedMart or any other platforms, they were actually quite fresh as well. So even after, when the lockdown was actually being lifted, these habits of actually shopping on e-commerce platforms still persisted until today. It's not to say that they do not go to the wet market anymore, but these habits of still shopping online is still around. Hence, from a superficial level, these were some things that was actually happening in 2020. However, what was actually happening to the economy? What are some of the fundamental shifts that we actually observe happening in the economy and for businesses alike? So I'm quite sure everyone actually remembers this news as it's actually quite recent. The closing down of Robinsons. Earlier last year in May, Robinsons actually announced that they'll be closing down their Gem outlet. And come October, they announced that they'll be completely exiting the Singapore market, closing down their last two outlets, one in Raffles City and their flagship store at the Heron. However, this trend is not something new or unheard of. All these retail malls slowly closing down is something that has actually been happening for quite a number of years already. Think back on Metro closing down their outlet at Centrepoint. How many of us actually still remembers John Little, or even the bankruptcy of Toys R Us? So these companies that I've actually mentioned, they are not small, medium enterprises, but they're actually quite large companies with very long histories, and yet we still see them actually slowly getting phased out or dying away. And this is actually quite similar to what I'm actually observing in other countries, developed countries such as US or UK as well. In the US, we have retail malls such as Sears, Macy's, Neiman Marcus, etc. They are all also slowly closing down. And in the UK, we see Debenhams going to liquidation, Marks and Spencer's closing down most of their clothing line shops. So this trend, as I said, is not something new, and it has actually been happening for quite some time already. And this is actually the same for the Singapore banks as well. In early 2020, during the COVID-19 lockdown, I actually attended our three local banks AGM. And during the management's discussion, one common thing that all of them were actually saying was that they were actually rethinking their branch strategy. And the reason for this is because of the lockdown, most of their customers were actually forced to actually do payments online, transactions online. And because of this huge shift in digitalization, how most of their customers have suddenly gone digital, banks do not actually need so much physical branches anymore. And that's the reason why they're actually rethinking their branch strategy. Why continue paying so much rentals for these physical branches when not many customers will be going to the physical branches anymore? And after the COVID lockdown, DBS was one of the fastest I saw rethink their branch strategy. How many of you actually remember or actually have been to the POSB branch at Takashimaya, which was located at about, I think, level 4 or 5? This branch today is no longer there. Other smaller branches along Orchard Road have also started to disappear, such as the one outside Marriott. So now, as we can actually see, retail malls are slowly dying or phasing out. Banks are actually rethinking this branch strategy. But what does this mean to us as investors? And just follow me in my thought process on this. So the supply of retail space is pretty constant because, let's be honest, it's not like Ion or Wisma or Neon City or any other malls is just going to collapse and close down. They will still be around. And that's the reason why I say the supply of retail space is going to be fairly constant. It's not going to just disappear overnight. However, the demand for retail space is actually trending downwards. As like I said, there's this huge digitalization happening. Consumers are actually shopping online. People don't actually mind going to buy stuff on Shopee, Lazada. So businesses, retail shops, small retail shops are actually rethinking about, do they actually need so much offline presence? Do they need to actually be spending money on renting a shop when their shop can actually be online? And that's why I say that the demand for retail space is actually going to be trending downwards going forward. And this digitalization is not, it actually has been happening for quite a number of years already, but it was because of the COVID-19 pandemic that actually accelerated this entire shift. So it's economics 101, demand and supply. If the supply of retail space is going to remain fairly constant and the demand of retail space is going to be trending downwards, it just means that the fair rental price, the fair rental rate is going to shift downwards as well. And if you think about it, valuations of companies are just a function of the returns of the companies, such as the return on equities of companies. If your rental rates are going to be shifting downwards, it means that the return on equity of your company is going to be shifting downwards as well. And this is a fundamental shift downwards. It's not something that's temporal. It's a real shift downwards. So with ROEs trending downwards, it just means that your fair valuations or your fair intrinsic values of such companies will be fundamentally shifted downwards as well. And that's the reason why I'm actually very, very extremely bearish on, your property landlords in Singapore, Hong Kong, or any part of the world, simply because I do not actually know what this shift is going to become. Whether is it 0.6 times book value, 0.5 times book value, or even 0.3 times book value, I do not actually know where is this new fair valuation for these retail malls or property landlords. So I'd like to share with you guys this quote by Satya Nadella, who is the CEO of Microsoft. And I find that this quote actually accurately captures the idea that I actually want to be sharing with you guys. And it's actually similar to what the banks is actually saying. And that's the reason why the banks are actually rethinking their branch strategy as well. And due to the COVID-19 lockdown, Microsoft has actually seen 2 years worth of digital transformation happen in just a span of 2 months, which was actually the lockdown period. And companies have actually been adapting themselves to better position themselves for this post-COVID world. And as investors, I believe that we should actually be doing the same thing as well. Because like businesses, our investment portfolios only has 2 options. It either stays constant and become extinct at one point in time, or it learns to adapt and actually survives in this new world. So now that I've actually reviewed, what has actually happened in 2020, now we will be moving on to the crux of today's presentation, which is how can we be looking at our portfolios for 2021 onwards. So in this slide, I've actually outlined some of the major fundamental shifts that comes to mind over the that has actually been happening over the last 10 years or so in the economy. And when I actually share these fundamental shifts, it may seem very obvious to you guys, but we may not have actually been consciously positioning our portfolios to actually ride these fundamental shifts. So even before COVID, it's not that I was living under a rock and I was totally unaware of, all these e-commerce platforms. I myself have actually used these e-commerce platforms as well. But from an investment portfolio point of view, I was just not well positioned for this fundamental shift. So some of the fundamental shifts that I actually see today are as such. Firstly, it will be platform shift. Now, there have actually been many platform shifts. And one such shift is, back in 2010, I was actually using a BlackBerry mobile phone. And back then, using a BlackBerry phone was actually quite a in thing. It was quite a big thing to me as well. And sometimes I'm actually quite thankful that I was actually born in the 1990s. I was fortunate enough to actually experience the shifts in how, let's say, your mobile phones have actually changed from how most people do not actually use mobile phones to the first mobile phone where your screen size was only just sufficient to actually key in your handphone number to dial your friends or whatsoever. Before we actually started shifting to bigger screens, your Nokia phones, which were black and white, no color at all, and you could even play Snake on your Nokia phones, I remembered, to BlackBerry phones. And back then, BlackBerry had this platform whereby they had this thing called the BlackBerry Messenger, which is only exclusive to BlackBerry mobile phone users. And it was really quite a big thing back then. Now that I look back, at the times when I was actually using a BlackBerry compared to the iPhone, the BlackBerry clearly is nothing wowing about it. But back then in 2010, a BlackBerry phone was actually quite a big thing. So we have actually seen a shift in platform as well, from BlackBerry phones to platforms like today, your iOS or your Android platforms. Some other platform shifts, which is actually more prevalent and became more popular last year especially, will be the shift towards the subscription platform. So, companies have actually been shifting their business models to a more subscription model, otherwise known as the subscription economy. And the beauty of this subscription economy is the compounding nature of relationships. You first acquire a customer, and then you actually charge the customer for the value of the services that you're actually providing for. And as long as the customer is actually happy with the services that you're actually providing them and actually agrees on the value to actually pay you, this customer will actually continuously pay you for a very, very long time. And this subscription model idea was actually first started by Salesforce, and is actually still in its infancy stages. It may have already been about 20 years since they actually started this subscription model, but 20 years is actually still quite a short amount of time, because if you think about it, how long have the retail industry been around or any other industries been around? On a relative basis, 20 years is actually still in its infancy stages. And as you can actually see from this slide, I actually shared with you guys this recurring revenue model. And as investors, this is what you'll be looking at, for companies within this subscription economy. Companies within the subscription economy, on day one, in month one, you realize there'll be a huge upfront cost because they have to actually acquire customers. And in this example, the cost of acquiring one customer is $90. And as long as the customer is happy with the services you have rendered and agrees on the price to pay you, which is $10 in this case, he'll constantly continue paying you this $10. And as you realize, as of the 9th month, you will have actually have an accumulative revenue of $90, and you have actually made back all the initial costs you put in to actually acquire this one customer of $90. And come the 10th month onwards, that's where you make pure profits. And this subscription economy model is otherwise known as the software as a service model, or otherwise known as the SaaS model, which is a term I believe many of you have actually heard before, especially after how popular it actually got last year. And you actually realize a lot of these SaaS companies, their share prices have actually skyrocketed last year because of the COVID-19 pandemic. So here are some examples of notable companies within the subscription economy that is actually earning recurring revenues. Some of them may actually be companies that you are actually more familiar with. You may have actually used them in your daily lives, like Netflix, even Zoom today. The Zoom technology is actually powering this entire webinar we're actually having today. Or in your businesses, you may have actually used these SaaS companies as well, such as Twilio, Okta, DocuSign, Fastly. And I think the best example would be Netflix. We are constantly paying this subscription fee on the monthly basis to actually stream our favorite TV shows or movies today. And as businesses, to make things more efficient, we use services such as Twilio, Okta, DocuSign, Fastly, Zoom. And looking at the share price increases of all these companies as of last year alone, you actually realize how much attention is actually these companies are actually getting, simply because of how companies are actually adapting themselves to the new world and using such services to survive and actually improve themselves. So, some of you might be thinking, is this shift, this platform shift, only isolated to these younger and newer companies? And that's not true. Even all household names have actually been shifting towards the subscription model as well. And that company is essentially Microsoft. This actually happened back in 2011 when they actually had a change in strategy because Google actually released Google Apps, which was targeted towards businesses, which is otherwise known as G Suite today. And this was actually targeted at Microsoft's cash cow, their enterprise customers. And Google Siege actually worked. Companies actually started shifting over to Google in the cloud rather than actually having to deal with issues of installing and maintaining or managing the Microsoft Office offline. And in the current workplace, a cloud solution actually allows companies far more variability in their work processes. And that's when Microsoft decided they actually had to change their strategy. And many years ago, back in 2010, you actually realize that when you actually bought a Windows computer, you will probably buy a Microsoft Office CD-ROM as well, to install into your computer. And back then, of course, now you probably don't see this anymore, simply because it's pre-installed into your computer, or our computers today don't even actually have a CD drive for you to be buying a Microsoft CD. But back then, you buy this one CD, you pay a fixed price, and you can actually use it in perpetuity forever. The only time you probably upgraded your Microsoft Office version is when you actually upgrade your computer and you actually decide to actually upgrade this CD as well. But that was in the past. Today, Microsoft Office has actually rebranded themselves to be called Office 365, where you either pay a monthly subscription fee or a yearly subscription fee, and your Microsoft Office version will always be able to stay updated to the latest version. Hence, you actually realize, that this subscription model is not something limited to really, really new or young companies, but older companies, the household names such as Microsoft, Adobe, or Gillette, which is the razor blade company, is also shifting their business model to a subscription model as well. So the second fundamental shifts that we have actually seen would be the shift from web-based platforms to app-based platforms. So back in 2010, or even earlier than 2010, we did most of our entertainment or communications on web-based platforms. And back then, the trending web-based the trending browser was actually called Mozilla Firefox. I don't know how many of you actually use Mozilla Firefox today. Most people actually use Google Chrome as a web browser today. But back then, Mozilla Firefox was actually the trending web-based browser. And our entertainment use of like Friendster, MySpace, or even Facebook before they actually started having a Facebook app was actually all based on the web-based platform. Even our games, if you're playing Flash-based games, it was also on the web-based platform. So most of what we actually do today was actually conducted via the browser, whereas now we're actually doing it on the phone through apps. The third fundamental shift is the dominance of mobiles. And this is actually a tie up, with my second point on how apps are actually becoming more and more prevalent. You imagine today going out of your house without your mobile phones, how handicapped will you actually feel? And this is even more so in a country like China. Having been to China numerous times, if I forgot to actually bring my mobile phone out, or I do not actually have a mobile phone, I'll be severely handicapped if I didn't actually have a mobile phone. Hailing a ride, paying for food, communicating with friends, booking a restaurant, getting a queue number for the restaurant itself would all not be possible if I do not actually have a mobile phone in China. So you realize how mobile phones are actually gaining in dominance, how they are becoming a part of our lives. If we do not actually have our mobile phone, it's like losing our right arm. It makes things very, very difficult for us to get about our daily lives. The fourth fundamental shift that we have actually seen is this concept of ownership versus experiences. And in recent years, this is something that I've actually observed in the younger generation. And I observed that the younger generation has actually placed greater emphasis on experiences as compared to ownership or owning something. And this is actually highly correlated to the sharing economy. Why own a car when you can actually take Uber or Grab? Why stay in a hotel when you can actually be trying out new experiences by staying in someone's Airbnb? Why climb the corporate ladder and achieve a corner office when you can actually be a freelancer and be, having the freedom to work anywhere around the world? And back then, business class seats on the plane was actually reserved or mainly taken by business travelers. But today's context, the younger generation are all wanting to actually fly in business class to actually experience it. And you actually realize, how the credit cards are actually shifting their reward system to actually mirror this shift in the younger generation as well. They're actually, instead of giving out cashback or giving you discounts, they're actually rewarding you with miles. And this is actually a reflection to actually cater to the younger generation, because the younger generation wants to earn these air miles to actually redeem air tickets and fly business class. And last but not least, it'll be the buy now pay later phenomenon, otherwise known as the BNPL phenomenon. This last shift is something that I actually want to elaborate more on, and it's something that I find not very prevalent in Singapore as of today. So these 5 fundamental shifts that I've actually outlined, they are by no means exhaustive. It's just the 5 top fundamental shifts that came to my mind that I actually see actually happen over the last 10 years or so when I was actually preparing these slides. There is definitely many more fundamental shifts. If you think about, in the last 10 years or so, how has things actually been shifting in the economy? I'm quite sure you guys can think out of other shifts that I actually did not highlight in today's slide, but these are the 5 that actually came at the top of my mind. So what is buy now, pay later? Is this recent trend where consumers are actually buying the products first, taking it home without actually having to fully pay it up on the first day and without incurring any interest on it. It's something like taking an installment to actually buy stuff. Some of you might even liken it to the installment plans that Harvey Norman or Best Denki might be offering. And yes, it is similar. And in the later part of today's presentation, when I'm actually sharing a case study within this buy now, pay later industry, you realize that I'm actually discussing more of a platform where multiple merchants are actually on it, where the platform offers this buy now, pay later scheme for all participating merchants on their platform. So it's not just exclusive to Harvey Norman or Best Denki. It's actually, let's say there's a platform where you have Harvey Norman, Best Denki, Toys R Us, etc. All these different merchants on it. And this platform is actually offering this buy now, pay later scheme as long as you shop at any one of these participating merchants. And if I have to take a guess, of what you guys might be actually thinking of now about such a business model, would be that people shopping on these platforms would probably be a very, very high credit risk. They probably would have already maxed out their credit cards, and they're actually turning to this kind of alternative lending platforms to continue funding their purchases. So before I talk more about this buy now, pay later phenomenon, I wanted to share some statistics about the changing credit card landscape that I have actually observed. Over the last 2 decades or so, you realize that debit cards actually becoming more and more popular, and this can actually be seen from the leftmost chart, as can be seen from the 2000s onwards. The debit card transactions have actually been increasing as compared to the credit card transactions for Visa branded payment cards. The same research has actually been done on MasterCards as well, and the research showed the similar results. And you actually realize that, debit cards are actually gaining ground as compared to credit cards. And come 2008, the amount of volume transacted on debit cards have actually caught up with credit cards. If you're still unconvinced, I have more statistics to actually show you how credit cards is actually losing its appeal. As can be seen from the leftmost chart, which shows the number of credit cards in circulation in the world and in US, what you actually realize is that in the US, since the 2000 all the way till 2019, the number of credit cards in circulation have not been increasing much. It increased from 1.4 billion credit cards in 2000s to 1.89 billion credit cards in 2019 for the US alone. And that's only a 32% increase over a span of 20 years. And if you can look on the right-hand side, the chart on the right-hand side, it shows the number of credit cards per person. And you actually realize that in the US, the number of credit cards per person has actually been decreasing of about 3.7 credit cards per person to in 2019, it was only 2.7 credit cards per person. And this is something that I can actually relate to. Having lived in London and moving back to Singapore, I have never really liked spending on a credit card. To me, it was always just spending within my own means via debit purchases on a debit card. Furthermore, the idea of having so many credit cards, never really appealed to me. I never really understood why people like carrying out so many different credit cards. The only reason why I actually got myself a credit card was because of the air miles. And yes, I'm one of those who actually reads MileLion very, very frequently, finding out what's the best way to actually maximize my air miles. But even though I decided to actually get myself a credit card, I also only applied for one credit card for myself because I find it's quite a hassle to actually maintain so many different credit cards. Hence, these charts and figures that I'm actually showing with you is something that I can actually relate to on a personal level. So, as much as I've actually shown all these numbers and statistics that shows that, credit cards is actually losing its appeal. Yes, the numbers are showing that the credit cards are losing its appeal, but we still have to actually understand the logic behind of why are credit cards losing its appeal. And you can actually notice from the leftmost chart as shown from this slide, it actually shows the average credit cards per person by generation. And you actually realize that as the generation passes, the average credit cards per person has also been decreasing. Your baby boomers had about 3.5 credit cards per person. Your Gen X had only about 3.2 credit cards per person. The millennials had only 2.5 credit cards per person. And your Generation Z only has 1.4 credit cards per person. And what you actually see here is that the younger generation is actually opting to have lesser and lesser credit cards. And comparing, let's say, my parents, who is the baby boomers, and myself, I can actually see it happening. My parents have way more credit cards than me. You use this card to go for dining because it gives you better rewards, or this other card if you go to Takashimaya because it gives you 10% more discount. they have way more credit cards to actually capture these kind of rewards as compared to myself, who only has one credit card. And much survey and research has actually been put into this, and the summary of all these research papers and statistics is as such. Many of the younger generation, having seen their parents go through the global financial crisis in 0809, have actually become more wary on using credit. They've actually seen the detrimental effects of using too much credit and being too overly leveraged up. Surveys have actually also shown that those the ages between 18 to 29 years, only 33% of them actually wants to own, or rather only 33% of them actually owns a credit card. So having understand this change in spending mentality, that the younger generation is not that they actually prefer to actually spend via debit purchases as compared to credit purchases. We go back to the initial question, on whether people using these buy now pay later platforms are highly leveraged or have maxed out their credit cards, so to speak. So when I actually first heard of these platforms, my wife was the one who actually shared it with me, because she had friends in Australia, and she was sharing with me how her friends in Australia, to just buying basic stuff, clothes, undergarments, of purchases of about 50 to 100 Aussie dollars, which is roughly about 50 to 100 Singapore dollars, they were actually funded via installments. And when my wife actually first shared it with me, I was actually quite shocked, honestly speaking. I was like wondering why, for 50 to $100, why do you actually have to take an installment for it? Because in Singapore, the only time we probably take an installment, it's to buy a house, to buy a car, or to buy bigger items, like your TV, your refrigerators. That's when we actually take an installment. But for basic stuff, 50 to $100, we probably just pay it up. So my initial thinking of these people in Australia were that they might be highly leveraged. They might have already maxed out their credit cards, that they had to actually turn to discount installments to pay for their basic necessities and products. However, it was upon deeper research that I actually realized that it's more because of a shift in spending mindset. And furthermore, as we can actually see from this chart in this slide, which actually shows the amount of cash balance in their bank account versus the total purchase price that they bought, you actually realize that it shows a very, very different story, and it's actually very, very congruent with what I was actually sharing about in terms of the shift in spending mindset. Sorry. On average, what this actually shows is that 50% of the consumers are actually using these buy now pay later platforms, have actually more than 5 times the cash amount compared to their total purchase price. About 21% of them have about 2 to 5 times coverage, and about 7% of them have about 1 times coverage. Only about 21% of them cannot cover for their total purchases. And that's about 80% of the consumers using these buy now pay later platforms. They actually have more than sufficient cash in their bank account to cover the total purchase price of the products that they are actually buying. And it's just more of a mentality that they actually prefer to buy it via installments. And upon deeper interviews, with these people, this 21% who cannot actually afford what they're actually buying, what you actually realize is that these people are actually either paid weekly or bi-weekly. And they are actually people who actually realize that that at a point in time, when they actually make the purchase, they may not seem to actually have sufficient cash to actually fund their purchases, but they know that as long as they get paid weekly or bi-weekly, the amount of money coming in will more or less will actually cover the amount of money going out to fund their purchases. So they are actually not that high a risk as what we thought it out to be. Therefore, from this, you actually realize, that the initial thinking that I had, or some of you might actually be having as well, that the consumers spending on these buy now, pay later platforms are actually not a really high credit risk. And it was actually just a misconception that most of us actually have. So the company that I want to actually be sharing with you guys today, it's called Afterpay, and it's actually listed in Australia. Afterpay is actually the leading number one player in the buy now pay later industry in Australia, and some of the biggest brands are already under them, such as Lululemon, ASOS, JD, Ray-Ban, Reformation, etc. And they have also become such a household name that Afterpay is becoming a verb, otherwise known as cognitive reference, where people will just say, why not Afterpay this? It's a verb, you know. Due to the lack of time, I will only be giving you a brief introduction to Afterpay. And I'll actually, at the end of this presentation, I'll also be sharing how you guys can actually get your hands on my write-up, my deeper evaluation of Afterpay. I'll be sharing how you guys can actually get that write-up. It's free of charge. But anyway, the revenue model of Afterpay is as such. When you use Afterpay to make a purchase, you need to only pay the initial 25%, and the remaining 75% is split over the next 6 weeks. That means the next 25% is paid at T plus 2 weeks, the third 25% is paid at T plus 4 weeks, and the remaining 25% is paid on T plus 6 weeks. There is no interest charge whatsoever. There's no late fees as long as you actually meet the payment deadlines on time. So unlike credit cards, that makes money from interest rates when you don't actually meet your payment deadlines, this is not Afterpay's revenue model. Afterpay charges 3 to 6% take rates to the merchants. So they make the money from the merchants rather than the consumers. And even if the consumer forgets to actually meet the deadline, if let's just say come T plus 2 weeks, you don't have the cash and you are unable to actually meet the payments, you are actually not charged an interest rate and you're only charged a fixed late fee, that's all. And the reason for this is because the company does not actually want to be charging interest rates, because this will actually snowball to a bigger amount that you will be unable to actually pay up. But of course, when you are unable to actually make you can't actually meet your payment deadline, what actually happens is that you are actually charged a late fee, a nominal sum, and the service actually terminates itself. You are actually unable to actually use the Afterpay platform anymore until you actually pay up the full amount. And to me, this business model or this revenue model is something that really attracts me. I find that their revenue model, it's a win-win for all the stakeholders within the ecosystems, be it the merchants, the consumers, and Afterpay themselves. Because if you think about it, for the credit cards, like I said, they make money only when consumers actually forget to pay their credit card bills, and they make the most money by charging you interest rates. And it's something, it's an irony to me. It's something like hospitals. Hospitals as businesses are in the business of saving people, healing people. But at the same time, their revenue model is based on, they need people to be sick longer so that they can actually, as a business, make more money. So that in itself is a contradiction. On one hand, you are trying to save people, and on the other hand, you only make money when people are sick. And that's the reason why I say that the Afterpay business model is something that really attracts me to it, because I find that it's more beneficial to all the different stakeholders. Because if you think about it, Afterpay, they make the money from the merchants. The merchants are the one paying Afterpay about 3 to 6%. So this is beneficial to the consumers. Although the merchants actually have to pay 3 to 6% to Afterpay, but because the consumers are now willing to actually spend more money, they will actually have bigger checkout baskets. So it's beneficial to the merchants as well. And for Afterpay, they'll be making this money of 3 to 6% from the merchants, and that itself is beneficial to Afterpay. And you realize that all the different stakeholders in this ecosystem is actually benefiting from it. And that's why I say that the Afterpay revenue model is something that really attracted me to this company. And just for disclosure purposes, I am actually personally invested in Afterpay as well. Like I mentioned earlier, Afterpay actually has become such a household name that people actually use it as a verb. It's a cognitive reference where people would just say, why not Afterpay this? And to back it up with numbers, we can actually see how much customer love there is for Afterpay, as shown by the Net Promoter Score, as shown by the chart in this slide. We can actually see how highly ranked Afterpay is as a digital payment solution, and it's actually ranked even higher than Apple Pay, PayPal, Google Pay, Samsung Pay, etc. Hence, we can actually tell that Afterpay is a highly loved product. Furthermore, this is just another example, of how much consumers love Afterpay, that 86% of the orders are actually from repeated customers, and Afterpay is always engaging with the audience, the people on their platform, to keep them engaged, keep them interested, and asking them questions like, what is the next brand would you actually like to see on the Afterpay platform? And there are times, when consumers, knowing that they'll actually miss their payment deadline, they will proactively call Afterpay up to actually inform Afterpay that they will be actually missing this payment deadline. And is there something that they can actually work out to make sure that they actually are able to continue using this service? And this also allows Afterpay to jump ahead in terms of the risk management to ensure, that they do not actually face high credit risk. And as of fiscal year 2020, they only had about 0.85% default rate. And this rate actually has been decreasing over time since 2018 of about 1.5% to today 0.85%. And therefore, I would say that the numbers are actually substantiating the logic behind this shift. I talked about how the younger generation are actually not really wanting to use the credit cards, but they are actually funding things via debit purchases, that they are not highly levered. And even though they're actually taking installments, it's more of a shift in spending mindset. And it's not that they are actually highly levered, that they do not actually have the cash to actually purchase these products. And that's the reason why we will actually see as well that the default rate is actually not very high as what we would think it to be. Because if people are actually highly levered and they're using this kind of alternative lending platforms to fund their purchases, we would naturally think that the default rates will be way higher. But as we can actually see, the default rates are not high. It has actually been trending downwards as well, to what it is today of 0.85%. Lastly, it will be the point on valuations. If we were to actually look at the current valuations of Afterpay, it has definitely risen quite substantially in the year 2020. However, I do believe that the valuations are justified given the growth rates of Afterpay and given how huge their total addressable market is. Because what Afterpay is actually doing now is that they are actually using the model they actually have successfully created in Australia and New Zealand. They are actually replicating that model onto the US market. And the key for the growth rates will actually be the expansion into the US market. So looking at all these different metrics as I actually shown on this slide, one will actually notice that the US market is actually showing much better numbers as compared to when Afterpay first started the business in Australia and New Zealand. There's way higher customer frequency, there's higher monthly underlying sales, there's higher active customers, and there's higher active merchants. Furthermore, the US e-commerce market is 11 times the size of Australia and New Zealand combined. The population in US is 10 times the population in Australia and New Zealand as well. And therefore, given the progress that Afterpay is actually making after expanding into the US for the first 2 years, I do believe that there's actually further upside for Afterpay here on and out. So, just a quick conclusion before I actually hand over the time for Q&A. I know there has actually been a lot of debate over the last couple of years or so, and especially last year, of whether value investing is dead. And people are saying that growth investing seems like the new trend, of investing in these kind of growth companies, so to speak. Personally, I do not actually like to differentiate between value investing and growth investing. I just believe that it's how value is actually being defined differently. And this is something that we actually have to recognize and actually adapt ourselves to, of how to actually define value. I know many individuals have been calling for the value rotation in 2021. They are saying that given what has actually happened last year, it's time for this rotation from growth companies to value companies once again. And I do agree with that. After how value companies have been bashed down so much in 2020, I do think that 2021 is the time for them to actually start recovering, as the vaccine is actually starting to roll out. That's when value companies will start recovering once again. But we have to be able to differentiate, what's a tactical play and what's an investment. I find that these value rotation, these value companies is something what I'll call a tactical play, that it's only good for the short term, but it's not really a long-term investment, given the fundamental shifts that I've actually outlined in this presentation today. So, like I said, I run my own personal blog. If you guys are interested to actually check it out, it's www.investingnook.com. Like I said, I'll be sharing my write-up on Afterpay as well at the end of this presentation. If you guys are actually interested to get a copy of this write-up, you just need to scan the QR code on the right-hand side of this slide. Just fill in the details and I'll be able to actually send you the write-up details. But I think we can actually move on to the Q&A session now. Sorry. So I think the first question is, with digitalization of many businesses, like banking and trading stocks, what is my take on counters that actually supports these businesses, such as Silver Lake Axis? So I do believe that, in the whole supply chain, that's why, like I said, as businesses continues to actually adapt themselves to better position themselves in this post-COVID world, companies like your SaaS companies, your Twilio, Okta, Fastly, DocuSign, they will actually benefit as businesses continues to actually adapt themselves to actually better improve themselves to suit to this new post-COVID world. As to Silver Lake Axis, I cannot say for sure because I have not actually looked into the company before. But if it's actually supporting these shifts, I do believe that they will actually do well as well. The second question is, isn't there also a shift from active investing to passive investing or to robo funds? So honestly speaking, I've never really fully believed in passive investing because end of the day, even choosing which ETF, which probably is what you would consider as passive investments, it is an active decision on its own. It's not that you just out of the blue, you just choose to actually invest into this ETF. You probably also have idea in mind of why you're actually choosing this ETF over any other ETFs. You also have to actually be monitoring these ETFs. And in the last 1 year or so, one of the most famous ETFs that I've actually been following is called the ARK Innovation Fund, the ARK FinTech Fund, and it's run by this lady called Cathie Wood. It's something which I find that's really interesting because she's actually opening up these funds to the retail investors. You can actually just buy it from the open market. And usually these kind of products is only reserved for private banking clients, your accredited investors, and not really open to the retail market. But whatever the case, these ETFs is also an active investment in some sense. They have actually engaged the investors quite actively. They share almost every month. They're actually sharing an update of the companies they're looking at. Cathie herself has always been going on interviews, sharing of her thoughts on the markets. So in that sense, I find that you may think that you're actually doing a passive investment, but choosing which ETF itself, it's an active investment decision as well. To be truly passive is really just leaving your money in a bank account and not doing anything. That's what I'll call a passive investment. The next question is, I don't think youngsters reduce credit card usage. In fact, they have many credit cards to max different cashback benefits. In fact, top up to e-wallet also through credit card. So I can't say so much for the Singapore market. Like I said, it's not something that is very, very prevalent in Singapore market as of now. I don't actually have the statistics for Singapore as well. But if you actually look outside of Singapore, like example, the Australian market, the New Zealand market, in the US, I have actually shown the numbers, the statistics that have actually shown that the number of credit cards per person have actually been trending downwards. And by generations, it is also trending downwards. So to answer your question, I can't really say for sure for the Singapore market, but for the overseas market, it's definitely something which is definitely quite true. The next question is, with the trend of doing our shopping online, are buying e-commerce and logistic counters a safe bet? Also, are data centers counters a good buy? Please advise. Sorry. So personally, I actually do believe in the e-commerce platforms. I personally have actually invested in a couple of e-commerce platforms as well. Examples are like Sea Limited, which actually owns Shopee. I've also invested in Alibaba, which actually owns Taobao. And like I said, it's a value chain. When I talked about how that there was this question on Silver Lake Axis supporting these shifts, it is a value chain. If you know that the company is actually supporting the shifts, the businesses that are actually adapting themselves will benefit from it, and naturally the businesses supporting this shift will benefit from it. It's just a value chain. So to answer your question, buying e-commerce stocks, yes, I do think that I won't say that it's a safe bet, because end of the day, these are really growth companies. And there's so much expectations baked into these companies that as long as you miss the expectations, that maybe let's say the market is actually expecting you to grow at 55%, and this quarter you turn out that you only grew at 50%. A 50% growth rate is still a very, very good growth rate. But because you just miss expectations, the market is going to punish you tremendously. And so it really depends on what you define as safe. If you're talking about a long-term investment for the next 5 to 10 years, then yes, I do believe that in that sense, it is safe, because you are actually investing for the future. But if you are thinking of short-term gains, I won't actually call it a safe bet, because there's so much volatility. You never really know whether the company will continue meeting expectations. And at some point, as with life, there's its ups and downs. You cannot always be scoring the highest mark. You have hit 50% this quarter. You can't be getting 55% next quarter, 60% the following quarter, and keep on increasing that way. At some point, things will start slowing down. And that's when the market will actually punish you greatly. And if you're actually not ready for that volatility, then in that sense, it's not actually a very, very safe bet. But to answer your question on the data centers and all that, I do believe that the data centers play is actually quite a good area, a good opportunity to actually be looking at. Data centers that are actually supporting all these e-commerce platforms in China, such as GDS, 21 Vianet. I do believe that they are actually good opportunities to actually look at. I personally am invested in data centers as well. Even in Singapore, you have 2 data centers. One is Keppel DC Trust. The other one is called Maple Industrial Trust. I have actually talked quite a bit about these 2 companies on my website. You can actually just check it out without me repeating myself too much in today's presentation. But I also do believe that, the data centers will actually benefit as people or these e-commerce platforms are actually growing in size. Naturally, the companies supporting them, your data centers, will benefit as well. The next question is, what are the companies that will benefit from buy now, pay later? Is there a risk in their business model? I can't say for sure which companies exactly listed will actually benefit from the buy now, pay later. But the buy now, pay later industry, it comprises of a few players. One such player is Afterpay. There's another one which is US listed, called Affirm, which just got listed recently, and they are actually backed by GIC. So you can actually check out these different players. But generally, looking at all the different competitors, what I've actually seen is that people have actually preferred Afterpay much more. They have different business models. You know, some of them might charge you a much higher interest rate when you actually don't make your payments and all that kind of stuff. So they vary. There are slight differences between all these different competitors, but I personally actually preferred Afterpay much more. Is there any risk in their business model? Like I said, the initial thinking was that the biggest risk is that the customers themselves are highly leveraged. You know, they take too much credit card loans, and that's the reason why they're actually shifting to borrow from these alternative lending platforms. That was the biggest risk to me. But like I said, you know, if you actually research deeper into this industry, you actually understand the change in spending mindset and all. You actually realize that this risk that is perceived by the market is actually not a risk to me. In fact, I actually see that it's actually quite safe. You know, because the younger generation shopping on the buy now, pay later platforms are actually not a huge credit risk. And Afterpay controls this risk very well as well, because it's not like on day one when you're on the Afterpay platform, they'll give you any amount of money to spend. There is a cap, you know, and even if you have been on the Afterpay platform for quite a number of years, it's not like you can use the Afterpay platform to buy a car or buy a house, you know, so to speak. It's actually small purchases like your clothes, your undergarments, shoes, fashion products essentially. So these do not actually amount to very, very huge amounts. And on day one, it's staggered. You are not able to actually unlock the maximum credit limit on day one. You actually have to slowly build up your profile, prove that you're actually credit worthy before Afterpay actually increases this cap on you.
Okay, Yiling?
Oh yeah.
Yeah. Okay, so great. Thank you for Tiling for sharing with us on how to look at our 2021 portfolio. Yeah, so thank you very much. So the next section will start at 8. So the topic is 重塑大马开启国际投资旅程. The speaker will be Winnie. So later you guys can just go into the program and then click and then to continue watch at the 8 p.m. section. Last but not least, remember to click on the virtual hall and we have some surprise for you. Okay, thanks again for joining us today, and thank you Tiling for sharing with us, and we will see you in the next section. Thank you very much. Thank you.